to see if I can get one of those zoom cameras. But can you guys see that?
Yeah. Yeah, we can see it.
How's that look? Does that look pretty good? Yep. How's that?
Yeah, looks
Yeah,
good.
that's good.
Okay, awesome. All right. So I'm going to walk you through this. I know it looks like a mess, but I'll walk you through it slowly. You probably want to follow along and take notes on this as I'm going through it. Okay. All right.
All right, sounds good.
Okay.
Yeah.
So first thing you want to do. This is the modern and postmodern portfolio theory part of the exam. So we went through most of the exam except for the the portfolio piece right there, which is what we're going over. And then you already know the derivative trades, but I'll go through those on Monday. I'll take you through the technical analysis like I'm doing here. And then you've already done these, the intrinsic valuations, from the pre-test. And I'll go over that really quickly. And then I provided you the solutions, to the problems at the back. And I'll make sure I post the lectures that I did before we went into coronavirus fun. So what you want to do when you lay out, and I'm going to go through this on the board, is the first thing you want to do. That looks actually like it's backwards on the screen. Damn it. Is there a way to just go to camera on this thing?
It's not backwards.
What?
Yeah, it doesn't look backwards.
Yeah, it's not backwards.
Oh, it doesn't look backwards for you?
No.
Okay, cool. So it's like this. And then like this. And then,
Yeah.
Okay, great. Thank you. And then what you want to do is put the graph in like that. Okay? And then you want to put E in parentheses, R to the P, and that's your expected return on the portfolio, is going to be on the y-axis here. And then down here on the x-axis, you want to do standard deviation, P, which is the risk of the volatility of in the portfolio. This is portfolio theory that I'm doing right here. And you already calculated the portfolio standard deviation in your pretest, so you already know how this is actually set up. Then what you want to do is you want to put a dot right here and then draw this line right here like that. And that line right there is the capital allocation line. The capital allocation line, or in parentheses, you want to put CAL, okay, right there. So this is the capital allocation line. This is your expected return on the portfolio, and this is the portfolio standard deviation. And then where this line intersects right here, you're going to put an RF right there for risk-free rate. Okay, that's like the return on the 10-year treasury right there. Okay, everybody follow so far?
Yeah.
Yeah.
Okay. And then what you want to do, this is the way I draw it out, so you want to learn how to draw it out like this. Is you want to put a dot right here. Right there, you put a dot right there in the middle of the capital allocation line. And then you, from there, you draw the line like this and put another dot right there. And then you're going to take the line from the dot here, and you're going to draw a line like this and put a dot right there. Okay? And then what you're going to do is you're going to draw out this umbrella like this and connect it. So this is an umbrella, and then what I do is I put dots here, dots there. I put dots in the umbrella, and then I put dots along the efficient frontier, and I put dots inside. And basically what you're doing, the theory is that when I'm constructing portfolios for my investors, I'm looking into the stock market, the bond market, the real estate market, into these markets, and I'm basically buying these assets and constructing them into portfolios based on assets that are available in the marketplace. And these dots along the efficient frontier and dots in the efficient frontier are actually portfolios that I can construct. Okay, I can actually go put them together and build these portfolios. Portfolios outside of the efficient frontier are infeasible portfolios. I can't construct them. There's nothing available for me to do it. So I'm forced, to build portfolios along the efficient frontier and in the efficient frontier. Okay, does everybody get that?
Is the efficient frontier like the umbrella?
Yeah. So these dots along the efficient frontier and at the end, and along the efficient frontier and inside the efficient frontier are portfolios that I can actually construct. Okay?
Okay.
And then this dot right here on the end right there, you want to write 100% stocks. So 100% of my portfolio is just in stocks. And down here, at the end here, 100% of my portfolio is in bonds. And then what I do is I'll write that out, and then I'll put some dots down here and put standard deviation P stocks. So this is my standard deviation for my stock portfolio. And then I will take the dot, and I'll do dots across here to here, and this is going to be my expected return on my stock portfolio. And what you can see that when you build portfolios of stocks, not only does it give you high return, but you're also taking on a lot of risk, a lot of volatility. Does everybody get that so far?
Yes.
Yeah.
Yeah, and then you want to do the same thing for the bonds. Put the dots, standard deviation, portfolio, bonds, expected return, portfolio, bonds. Okay?
Okay.
Okay. So then, obviously, investors, they want to be up here, right? Right? High return, low risk.
Yeah.
Yeah. But the problem is I can't build a portfolio with high return, low risk because there's no such thing. Okay? So what investors are looking for utility in their investments. So obviously they want to be up here, right? On this utility curve. They want high return, low risk. But there's no portfolios out there that provide high return, low risk. So what they need to do, and I write in 2 more utility curves, but make sure that this third utility curve, the curve is tangent to the efficient frontier and the capital allocation line. So it comes out like this and comes out like this. So since investors want to be up here but they can't be up there, they have to lower their utility to the point where the portfolio that is available to them is the M portfolio, the market basket portfolio, is the point where the investor's utility curve is tangent to the capital allocation line and the efficient frontier. Bam, right there. And these market basket portfolios have become extremely popular from an investor standpoint, because they basically say, well, why should I pay you all this money as an active manager where you can't even beat the market? Just replicate the market and sell me a vehicle that basically tracks the market for very low fees. So that's the market basket. And then you want to put the dots, expected return on the market and portfolio standard deviation on the market portfolio. Does everybody get that so far?
Yeah.
So then what's cool about that portfolio is that the expected return, that's the portfolio that provides the investor with the highest risk-adjusted rate of return. And you've already calculated that in your pretest, because it's the inverse of the coefficient of variation. So it's the expected return divided by the standard deviation is the risk-adjusted rate of return. That market portfolio at that point right there provides the investor with the highest risk-adjusted rate of return. Bam, awesome. So me, as the portfolio manager, if I can provide my investor an 8 to 10% rate of return and lock that in, and replicate the market and lower the risk on the portfolio through diversification, I can provide my investor not only with the highest risk-adjusted rate of return, but if I can get them 8 to 10% rate of return, I can double their money in less than 10 years. So let's say the market is providing a 10% annual rate of return. Under the rule of 72, 72 divided by 10, how long does it take me to double the portfolio value?
7.2 years.
Yeah, what's 72 divided by 10?
7.2 years.
Got it. So that's what investors are looking for. The other thing is, let's say I'm an investor and I want higher return and I'm willing to take on more risk. What I can do is I can sell off my bonds and start buying more stock. I can move up the efficient frontier. I'm going to get a higher rate of return, but I'm also taking on more risk, but I'm getting a higher rate of return, and that's what I wanted. So I'm willing to take on more risk to get a higher rate of return. Maybe I'm an investor where, hey, you know what, I really don't care, about return really. I'm just worried about risk. We just saw that with the negative interest rates. So what I want to do is I want less risk, and I'm willing to take less return. So what I'm going to do is I'm going to sell off more of my stock and reallocate my portfolio more towards bonds. And by doing that, I'm lowering my return, but I'm significantly lowering the risk on my portfolio. And what I can do is by selling off the stock, I move down the efficient frontier. I start to move down the efficient frontier. Okay, is everybody comfortable with moving up, moving down?
Yes.
Okay.
Yeah.
So you can also, some investors, they say, hey, I don't want to just increase and decrease my stock bond portfolio. What I want to do is actually jump off the efficient frontier onto the capital allocation line and move up the capital allocation line to get higher return. Yes, I'm willing to take on significantly higher risk to get the return, but I want higher return, and I'm willing to take on more risk. And the way that investors jump off the efficient frontier and move up the capital allocation line is through the use of leverage. Okay? Now, we do it, your parents, grandparents use leverage all the time. When you buy a house, you're going to put down the down payment, which could be 10 or 20% of the house, and then you're going to borrow the rest from the bank as a mortgage. So you're leveraging your equity that you put into the house. Just as long as the value of the house continues to go up, your return on equity, the return on the down payment that you put in, is going to go up exponentially. But if the value of the properties go down, then the return on your equity is going to go down exponentially. So leverage is a two-edged sword. When prices are going up, you get exponential increase in your return on equity. If prices are going down, you get exponential decline in your return on equity. I can also leverage my stock portfolio by borrowing margin from the brokerage firm. So I can buy stocks on margin using borrowed money to lever up my return on equity if the stock prices are going up. But if stock prices are going down, then my return on equity turns negative at an exponential rate. So again, I can jump off the efficient frontier onto the capital allocation line, move up, get higher rates of return, but it's significantly higher risk. Investors can also jump off the efficient frontier down here at the tail end of the efficient frontier, and they can move down the capital allocation line through the process of lending. And that's what banks do. Banks say, you know, we're totally conservative, we don't want to lose any money. We would rather do is actually lend. We're going to get significantly less return, but we're getting extremely significantly less risk. So what we'll do is we'll lend. So I can jump off the efficient frontier, move down the capital allocation line through the process of lending. And the way banks do it is they're more than happy to lend you money as a mortgage to buy the house because you don't own the house, technically. The bank owns the house. And until you pay off the mortgage, once you pay off the mortgage, the bank will give you the fee or the title to the property and you will own it free and clear. But up until then, you don't own the property. You have control of the property. You will make your mortgage payments. And if you stop making your mortgage payments and you default on the loan, the bank will basically foreclose on you and take your property as collateral to back the loan. And it's the same thing with the margin account from the stock brokerage firm. If the stock prices go down and you get a margin call and you can't put up the money, they're going to liquidate your shares to pay off the loan, the margin loan that you took out to buy those shares in the first place. Okay. Does everybody understand this?
Yes.
Okay, perfect, awesome.
Yes.
You guys are awesome. So the last piece, which is down here, is over the decades. Give me a second. Okay. Over the decades, the market basket up there has changed as new asset classes have been introduced into the capital markets. And if you go back in time, like before in the 20s to 50s, 20 through the 50s, if I had a client and they wanted me to build a portfolio for them, I was only restricted to two asset classes, bonds and stocks. And the allocation that we recommended based on the market was you would have 70% of your money in bonds and you would have 30% of your money in stocks. That was the market basket. But in the 1970s and the 1980s, there was new real estate capital markets that were emerging and new ways of investing in real estate. And we all knew that real estate was a huge asset class, but people couldn't get access to it. So this company called Ibbotson and Associates did this research and basically told investors that you need to have 10% of your portfolio in real estate. And because real estate acts like bonds, that we would take from the bonds, reduce the bond allocation to 60%, keep the stock at 30, and then increase and then allocate 10% of the portfolio to real estate. That was like a big deal. And then in the 1990s, Ibbotson did the research again and basically said, hey, you investors, you guys need to have an allocation of your portfolio in cash value life insurance. Because as you pay the premium, it's accumulating cash value. The risk is super low. It gives you a decent rate of return. If you die, the death benefit goes into your portfolio, so your heirs are a lot better off, and it's ultra safe. So you should have an allocation of at least 10% into cash value life insurance. And actually the banks, they embrace this so much that they put insurance policies on all of their senior executives, funded the insurance policies, accumulated all this cash value, and then the Federal Reserve and the bank regulators said, hey, that cash value is so liquid, it would constitute tier 1 liquid capital, so that when we are basically examining the bank, if you had these life insurance policies with cash value on your principals, that would count as liquid capital for the bank. So it institutionalized this asset class in the 1990s. And then currently in the 2000 period, a new asset class has emerged, and that is alternative renewable energy. Alternative renewable energy has become a new asset class. And what is alternative renewable energy? Geothermal, biogas, wind farms, solar farms. Those are that's a market that's now emerging as a new capital market. So based off of research from Deutsche Bank Reef, they basically ran the analysis again and said you need to have 10% of your portfolio, your target portfolio and your model portfolio for the next 40 years into alternative renewable energy. Now the real estate, life insurance, and the renewable energy asset classes are what are considered alternative assets, or alts, alternative assets. And what's great about these alternative asset classes is that the returns on these asset classes have low, no, or negative correlation with stocks and bonds. So if I introduce these alternative assets into a stock bond portfolio, what happens is the efficient frontier bows out. It bows out, which is unique. Now, yes, I'm going to get lower return on the portfolio. I'm getting lower expected return on my portfolio, but I'm getting significantly less risk. Significantly less risk. Which means that because the risk is reduced more than the return, my risk-adjusted rate of return goes up. And if I can get my investor an 8 to 10% rate of return under the rule of 72, I can double their portfolio in less than 10 years. Boom, I'm done. So all of a sudden, if I can do that as a manager, as money's going to come into my company, I'm going to be deploying and managing these portfolios. And if I charge 1 percentage point on the $1 billion, I'm making $10 million a year. If it's 1% on $2 billion, it's $20 million a year. $3 billion, 1%, $30 million a year. That's how these investment companies operate. This is basically the theory in which they're trying to implement going forward. The last piece, how much time do I have?
10 minutes.
Perfect. So the last piece, which is really interesting, is that me and my wife and other individuals, we manage portfolios, we run different companies, we sit on boards of directors of nonprofits and for-profit companies. I have to take care of my family, my brother's family, my sister's family, so I have all of these responsibilities. So to mitigate the damage, if something was to ever happen to me, I need to have a ton of life insurance. Because what will happen is, if something happens to me, the death benefit will go into the estate, and the expected return on the portfolio will jack to a higher utility curve and provide a higher expected return on the estate on the portfolio. And the investors originally, the stakeholders originally, wanted to be on a higher utility curve from the very beginning. So unfortunately, I have to pass away for this thing to work, but I really don't care about that. What I care more about is not to disrupt and destruct the institutions around me, and to provide liquidity and to provide a death benefit that will increase the expected return on the portfolio and allow the money to be able to hire people to backfill my expertise to mitigate the damage on the nonprofits, the for-profits, my family, and the estate. And I'll be able to use the death benefit to pay off the taxes and pay off all the loans, so everything goes to my heirs at a tax-free and debt-free. So that's really the ultimate objective. What I can do also, and then I'll end it, is I can bow out the efficient frontier and increase the risk-adjusted rates of return by introducing alternative assets into my stock bond portfolio, because the returns have low, no, negative correlation. I can also bow out the efficient frontier using financial engineering, derivative contracts, to apply to my portfolio as insurance. And we all know from our memos that if we think the prices are going to go down, then I'm going to write forward contracts and write futures contracts. I'm going to write calls on futures. I'm going to buy puts on futures, and I'm going to sell short the stocks in the ETFs. Now, that's expensive, so my expected return is going to go down, but by using these tools, I'm applying the portfolio insurance, which actually reduces the risk of the portfolio even more than the reduction in the return. So I'm actually able to increase the risk-adjusted rate of return, and net of the contract costs, if I can get an 8 to 10% rate of return on my portfolio, I can double the portfolio in less than 10 years. That's the solution. All right. Any questions on that?
Nope.
Okay, I know that was a lot to go through. Again, there's some review videos up there if you want to go walk through it again. But I found that this lecture is extremely valuable for people who are interested in portfolio management, and this should help you going forward. So unless anybody, I'll hang out for a little bit because I got one more class. But if anybody has any questions, or maybe you can text me. I'm around tomorrow morning, later in the afternoon, and I'll be available all weekend too. If you guys want to do a Zoom call or have me take a look at anything, or need to talk to me or anything like that.
Sounds good, Sousa. Thank you.
Okay, you
Thank
guys.
you very much.
Awesome. You guys are awesome. I love you.
Thank you, Professor.
You're welcome.
Thank you. Thank you,
You're welcome.
Thank you, Professor.
You're welcome.
Thank you.
Take-
Thank you, Professor. I'm loving the jersey.
Thanks, buddy. I love it. Tomorrow or next week it'll be all blacks.
All right, I'll get you an Ireland jersey.
Oh, I love it. I'll tell you what. If you get me an extra large Ireland jersey, I'll give you my All Blacks jersey.
I got plenty, but I'll definitely see what I can do.
Okay, awesome.
All right, sounds good.
Thanks,
See
you
you
guys.
later.
All right, take care of
Thank you.
yourself. It's
All
great
right,
to
bye.
spend time with you.
All right. Thanks for your help today.
You're welcome. My pleasure. Bye. Thank you. Take care.